SOFI stock has been bobbing around the $14 range for the last couple of days. In fact, at the time of recording, the stock currently sits at $13.97. Now, if you're someone who has actually followed this company for quite some time, you actually remember that back in, between 2021 and 2022, this $14 region acted as support, where we actually saw SOFI stock bounce off this region a total of about 3 times before finally breaking through it. So investors have been saying that if we do break through the $14 level, momentum can perhaps drive the price of the stock up even further as we close out the year. Now, I am by no means an expert in technical analysis, but what I can do is to help us understand the fundamentals of the company and to understand what the company has to achieve in order to justify a price above $14 today. Because with the release of their third quarter 2024 earnings, I believe the dynamics of SOFI's business has changed, and there are 2 metrics in particular that I believe that we need to pay special attention to as we value SOFI as a company. Now, as long as these metrics do well, SOFI can potentially be set up for a great run in 2025, barring a recession. But as always, potential is a dangerous word, so let's dive in. Now, I began this video talking about the price of SOFI stock because I believe that the valuation of a stock is some function between sentiment and execution. Now, this is definitely something I've mentioned before, right? I've actually shown you this formula over here. If you want to hear me talk a little bit more in detail about it, I'll link the video over here. But the thing is, as investors, we have to understand that we cannot ultimately control the sentiment of the market towards a particular company, which is why investing requires a long time horizon. Now, what makes a good investment, is actually when a company is executing on a high level, but sentiment has yet to catch up. Now, that can actually be months, or in SOFI's case, years before that happens. And so the 2 metrics that SOFI reported, which demonstrated their high level of execution, is actually their member growth and their fee-based revenue. So let's break it down even further. Now, we have to begin by understanding that SOFI's vision is to become a top 10 financial institution in the United States by market cap. Now, market cap doesn't grow magically by itself, right? It grows because revenue and profitability of the company is growing. And in SOFI's case, revenue and profitability can be driven by its member growth. And I've made the argument for that previously in this video that I will link up over here. Now, if you take a look at some of the company currently in the top 10 list of financial institutions, you actually see that JP Morgan has over 80 million customers, Bank of America over 69 million customers. Down the list, you actually have Charles Schwab with around 36 million customers and Truist with 15 million customers. So looking at these numbers, SOFI still has plenty of room to grow, and the logic here is simple. The more people you manage to onboard onto your platform, over time, the more likely they are to actually use your products and services, and as they continue to do that, that will ultimately generate more revenue for the company, which will translate into a higher market cap. So all things considered, it does seem like, on the surface, SOFI still has a lot of room to grow. But how much room to grow exactly are we talking about? You see, SOFI should end the year with, slightly over 10 million members. Currently, the US population stands at 330 million. Now, but it's not that straightforward just to say that, SOFI has 10 million members, the US has 330 million, minus off 10 million from 330, and SOFI still has, a target audience of 320 million. Because SOFI's target audience is quite specific. They actually target an audience with an average FICO score of 746 and above, which is, I believe around 48% of the country, depending on what report you actually look at. When that's not too bad, right? That's still over 150 million potential members. But there's also a salary bracket that SOFI likes to work within, and that salary bracket is over $160,000 a year. Now, this report that I found was actually done in 2022 and updated in October of 2024, so the numbers here could be slightly skewed. But someone earning over $160,000 a year in the US belongs to the top 10% of earners, which actually shrinks that, target consumer size down to just 33 million for SOFI. And if you consider what it says in this report over here, that the top half of this 10% actually earn over $220,000, bottom half around $133,000 annually, that would actually mean that SOFI's ideal member is actually within the top 7 to 8% in terms of income earners in the US, which is less than 33 million. And so all things considered, it would seem like, on the surface, even if SOFI were to capture the majority of the market over here, their growth will slow down in the coming years if it's tied directly to revenue, right? Member growth tying directly to revenue. Either that or they will have to serve customers lower down the FICO ladder, which will actually increase their credit risk. Okay, but of course, as with all things, it is not that straightforward because they do have a solution for this, but more on that later because we have to talk about why member growth in the third quarter made me change my valuation. You see, Anthony Noto has previously spoken about how he expects SOFI to reach, a member growth of about 800,000 to 1 million members per quarter. And the reason why he said this is because, the long-term target for SOFI is actually for them to reach over 20 million members. Now, I believe he first mentioned this 20 million number back in September of 2022 in a Goldman Sachs conference. And I believe he said it again, sometime last year, where he made reference to this number and said that, he hoped to actually achieve this target in 5 years or less. I think his exact words were, he'll be disappointed if they are not at 20 million plus members in 5 years' time. So that will actually put his timeline somewhere between 2027 and 2028 at the latest. So what changed for me this quarter is when I look at member growth, the timeline of SOFI achieving this target actually shifted for me when I, realized what they did this quarter. Previously, I had them reaching the 800,000 member quarter sometime in 2025 and only achieving 1 million member per quarter in the second half of 2026. But with 756,000 members added in the most recent quarter, I wouldn't actually be surprised to see them close out the year by adding over 800,000 members in the fourth quarter of this year. And that would mean that, the 1 million member mark wouldn't be far off. I wouldn't be surprised to see them actually hit it in 2025 or by, the very latest in the early half of 2026. And this will eventually drive, revenue growth for SOFI as they continue to expand the adoption of their products over time across their member base, which brings me to my second point, their fee-based revenue. And so basically, after posting 80% year-over-year growth in the second quarter of this year, it was actually hard to see how SOFI can actually keep up, these numbers going into the third quarter of this year in their financial services without expanding the adoption of their products across the member base. So which is why in my initial earnings projection, right, I actually thought that, we will see an inflection upwards in terms of the products per member. But ultimately, SOFI took another route. They basically introduced a new business into their ecosystem, which is the loan platform business. Now, on a very high level, right, this loan platform business basically helps to increase their revenue per product, and I will show you how this affects the valuation later on. At the same time, this product is highly scalable. Basically, SOFI takes on little to no risk here to build out this new source of revenue because the loans are originated only once the contracts are in place, and these contracts don't include any loss sharing agreement. So this loan platform business, basically solves a couple of problems for SOFI. Now, previously, I was mentioning, how it seems like SOFI are actually boxing themselves into a corner by only serving a particular segment of the market, and whether or not they can become a top 10 financial institutions just by serving this bunch remains to be seen. But with this new addition of the loan platform business, they can continue offering their credit products to the more affluent customer, right? And take on the same level of risk that they are currently underwriting, while at the same time onboarding new clients into their other products that are, non-credit related. And perhaps some of these consumers, over time as they build their credit, can qualify to become a SOFI loan customer in future as well. And I think this gives SOFI basically an opportunity to underwrite a lower credit consumer with minimal risk, because eventually if they do decide to move down the FICO ladder and to serve consumers with a lower FICO score, they will actually need to adjust their underwriting models to basically fit this lower credit consumer. Now again, when we are saying lower credit, right, we do have to remember that the average FICO score of a SOFI customer is 746, so it's not like you're scraping the bottom of the barrel kind of thing. But at the same time, we have to understand that underwriting a different profile of clients require different skill sets, require different data points. And so this loan platform business basically allows them to get data on this group of potential customers in future without having to take on additional balance sheet risk. And I think importantly, this helps to diversify their revenue streams, because if you take a look at the 10Q, what you will realize that is basically in the second quarter of this year, the non-interest income actually declined 10% year over year, despite their net revenue increasing by 20%. And that actually meant that the interest income became an increasing percentage of their overall revenue, which is why, people like to argue that SOFI is just a bank and should be valued as a bank, right? Because the majority of their revenue is basically from interest income. However, in the third quarter of 2024, we actually saw this trend finally change with the loan platform business. The total non-interest income was actually 266 million, which is a 38% year-over-year increase, and the net revenue only grew by 30% year-over-year. And so that means, once again, the non-interest income is slowly making up a bigger portion of revenue, and if they continue to keep up this trend, investors and analysts are less likely to value them as a bank and more likely to value them as, a fintech. So of course, when it comes to non-interest income, there are a lot of other components within this, like, the gain on sale margin, interchange fees for credit card fees and things like that, as well as their fair value adjustments. But basically, adding this loan platform business is additive to their overall net interest income. And if you listen to their last earnings call, there's a huge emphasis on fee-based revenue and capital-light revenue. And I do believe this is an attempt from SOFI to change the market's perception of them as a company and to help investors and analysts to realize that they are no longer just a lender and their revenue is not solely tied to their balance sheet. They are able to grow revenue even though they do not grow their balance sheet, and they should perhaps be given a higher multiple because of that. And all of this is fantastic, but how does member growth and this loan platform business work together to generate more revenue for SOFI? And so to answer that, I actually have to bring you back to Anthony Noto's answer in 2023. He actually told us, and I've mentioned this before, that they plan to keep the product per member at 1.5 between the middle of 2023 until the end of 2024 at least. Now, there are a couple of things that can happen over here. I think the best case scenario and the most bullish scenario is that SOFI continues to drive member growth as they also at the same time drive adoption of their new products. And what that means is that we see an increase in the total number of SOFI members and the products per member. Now, of course, historically, this has never happened before. So that's the disclaimer over here. However, we do have to realize that we are entering unprecedented times for SOFI with the rate cut cycle beginning, and this will actually continue to drive up demands for their loans and make it easier for them to sell their loans. This will actually bring more people onto the SOFI platform into their financial services flywheel. Now, as for the path of rate cut, becoming clearer, what this does for companies, right, like Anthony Noto mentioned in the third quarter, is that this allows companies to be able to better budget for the transition into a modern banking core, and SOFI has that tech stack ready for them to use. And so, they will have a tailwind behind all three of their business segments for the first time in a long, long while. Now, I think the more likely scenario will be SOFI achieving its member growth target of 800,000 to 1 million members per quarter and eventually reaching over 20 million members sometime in 2027. And so my expectation is that in 2025 the products per member will not increase past 1.5. In fact, I will actually want to assume that it stays relatively constant to what it has been done in 2024, and I'm okay with this if it means that member growth actually meets their expectations and grow at 900,000 members per quarter. Now, another possible scenario is that the US enters a recession. I know at the moment the economic indicators are not showing any signs of a recession, but I guess we have to understand that some of these indicators are actually backwards looking. So at the same time, if you have been following the Federal Reserve, you actually realize that, Powell's tone kind of changed to become a little bit more hawkish recently. And last week, he basically said that there's no hurry on the Federal Reserve's part to actually lower interest rates. So I think this change in tone from his previous meeting in September basically got the markets a little bit confused, because back in September, he actually said that, if we had the September data back in July, we would probably have decided to start the cut in July. So this sudden change in tone, I think from a SOFI's perspective, to me at least, it's not too big a deal, because SOFI had previously planned for a 75 BP cut, and we actually already got that. So moving forward, of course, a slow and gradual cut is better for SOFI, and I'm not complaining here. But I think the chance that the Federal Reserve actually stays too restrictive and weaken the economy is there. And because of that, if they do weaken the economy too much and we enter a recession, now that would definitely be bad for SOFI, because in that scenario, we then have to assume lower member growth and lower products per member. Now, if we understand all of that, then we can start to talk about SOFI's valuation. And so basically, it's quite simple, right? The one thing that we want to keep track of and measure for SOFI is their member growth. And we want to see member growth between 800,000 to 1 million every single quarter for at least the next 2 years. Now, based on that, we are able to understand the total number of members SOFI has, and we multiply the total number of members by the products per member that Anthony Noto has guided for, which is around 1.5. Once you do that, you're able to, get the total number of products, and then you multiply the total number of products by the revenue generated per product to get the overall revenue for lending and financial services for SOFI. Now, once you add the tech platform revenue onto that, you can basically, get a bigger picture of SOFI's overall revenue and where it stands. Now, in terms of their adjusted EBITDA, the margin, we know that their long-term goal is 30% and net income margin of over 20%, which is in line basically with some of the other top 10 financial institutions. So at this point, I just want to say, I've been recording this with my throat still not fully recovered. So if at any point during the video, you have trouble understanding what I'm saying because of my pronunciation and I'm finishing my sentence too quickly, please leave your questions down in the comment below. And while you're at it, if you enjoy this kind of video, do remember to hit the like and subscribe button. Thank you for your time, and back to the video. So before we go any further, I want to take you through how this spreadsheet works. Right, so if you take a look at the tabs at the bottom, you will see the words business over here and financials. So basically, these are the two main databases where I will pull all my data from, right? And then I pull the data from these two main databases and use it in other tabs to draw relationships. So on this first page, you can actually see SOFI's total members added in the third quarter of 2024 stands at around 756,000 over here, right? Which you can see. I'm trying to use this ink thing. It's something new that I'm trying, so let me know if it makes it easier for you to follow. This is actually only a 34.7% year-over-year increase because SOFI actually removed some inactive members. So at the end of the day, there were only around 9.37 million members on the platform. Now, the next two segments are basically what you can see over here is the number of lending products and financial services products respectively. All these can be taken straight from the earnings report. And basically, you combine them and to see that actually SOFI has a total of 13.65 million products in the third quarter. So if you take a look at the bottom line over here, which I'm actually highlighting for you, you can actually see that the total products per member has been decreasing over time, right? But actually in the last couple of quarters, it has been quite steady in the 1.45 range. And so that's the number we are going to use moving forward, going into the fourth quarter of this year. Now, below this line, you can actually see at the bottom the total amount of deposits over here. So this is the total of savings deposits, demand deposits, and time deposits. Now, I want to pull up this screenshot over here for you. Now, if you take a look at this screenshot over here, it tells you that in the remainder of 2024, there's actually $637 million in terms of time deposit to be offloaded by SOFI, and that will happen possibly, in the fourth quarter of this year. So that is why, basically, if you take a look, you actually notice that the number or the amount of deposits isn't increasing as fast as it used to. So that's the reason. It's not because people are actually using the platform less, but it's because while they're actually, onboarding more savings deposit, they're actually also at the same time offloading some time deposits, which are of higher interest rates. Okay, but I won't spend too much time in this video talking about deposits. That is for another day. I basically just want to draw your attention to these two graphs at the bottom. Let me zoom in a little for you. Right, now this first graph on the left over here, you can actually see the green color bars, right? They actually represent the total number of SOFI members. And as you can see, that has been increasing in quite a steady trend. Now, at the same time, the orange line, which I'm going to highlight for you over here, you can actually see, this is actually the number of members that are being added each quarter. This is actually also accelerating every single quarter. So it's not just the total number of SOFI members that are growing. In fact, it's the number of members added each quarter is actually also accelerating, right? So that means the rate of change of member additions is also increasing. Now, why I like to look at this second graph side by side with the member graph, right, is because you can see that they were actually able to cross-sell quite effectively when they had a lower member count. Okay, so at the start here, you can actually see the number of products per member around this region was at around 1.52 products per member. Of course, over time, as they grew member count, this number started to decline as well, which is actually quite logical, right? Because the newer members tend to use lesser products and they will pull down the average. So, the fact that they are able to continue to grow members at such a rapid pace and still maintain this number at around 1.45, 1.46 is pretty impressive, which basically shows that, their products are being adopted by the members, and that is a good sign for the company. And like I was was saying earlier, for those people asking why there's an inverse relationship between member growth and products per member, I think basically you think about it like you're opening a new bank account, right? The likelihood of you using all their various products on day one of opening the account is quite unlikely. Usually it takes some time for you to, fully be embedded into the bank's ecosystem. Now, this second page, if you take a look at it, there are quite a lot of numbers. Basically, what I'm doing is I'm just tracking the revenue and contribution profit from each of SOFI's various segments. So all of these numbers can actually be taken from the earnings reports. So you can see net revenue, expenses, contribution profit, and this is for the lending segment, so on and so forth, for the tech platform and for financial services. So it's basically the same thing. Actually, what I want to really bring your attention to is whatever that is below this purple line over here. Now, below this purple line, what you can actually see is the adjusted net revenue and the year-over-year growth. So if you can see over here in the third quarter, adjusted net revenue came in at $689 million, and basically that represented a 30% year-over-year growth. Okay, in terms of the adjusted EBITDA margin came in at 27%. Now, like I said previously, we know that their long-term target is 30%, and they have achieved that previously back here, okay, in the fourth quarter of 2023, so that we know that long term this is definitely something that is achievable. Now, in terms of net income margin, it was 8% back in fourth quarter of 23, slowed down a little bit in the first half of this year, and then now it picked back up to 8.8%, so let's call it, coming in around 9%. Now, just two things to point out over here based on the graph. If you take a look at the graph below, right, this basically, actually shows the breakdown of SOFI's overall revenue. Now, I believe SOFI does show this graph as well in their earnings report, but I prefer to rely on this rather than the one SOFI shows, because in SOFI's graph, they basically lump together their tech platform and their financial services. So for me, I actually broken it up over here. Now, if you take a look, this green color component, this is the financial services platform, and you can actually see this green color component was basically just a line back in 2021. So you can actually see the growth over the years. However, in the case of the tech platform, definitely you can see there's some growth, but over the last couple of quarters, if you just take a look at this pink bar over here, right, the size looks more or less the same, which basically shows that, the growth has been a little bit stagnant in the last couple of quarters. And then if you take a look at this graph on the right, this basically shows you the revenue trend, which is, going up and to the right, along with EBITDA and net income. I believe because the revenue number is so big, the impact of its net income is not clearly seen. Let me perhaps remove the revenue and see how the graph looks like. So if I were to select the graph, select data, I remove the revenue for a while, and let's take a look at the graph. Okay, you can see this pink color bars basically represents the adjusted EBITDA, and you can see it shows actually very, very strong growth over here. And then let's see what happens when I remove the EBITDA as well. If I take this out, okay, what we're left with is the net income, and you can see in terms of their net income, it's in an upward trend, and then it basically inflected upwards in the fourth quarter of last year, and we are moving more or less in the correct direction. Okay, so moving on to the next tab, basically you can see over here under fundamentals, what I've done in this tab here is to actually pull some of the data from the first two pages that I was showing you earlier, and to draw some relationships with all these numbers over here. So there are a couple of things missing on this page, definitely for sure, like usually gain on sale margin will be here and things like that, but I've been sick, okay, so cut me some slack a little bit, right? But what you can see over here is that we actually take the total number of SOFI members divided by the total number of products, and then we actually found the products per member, and basically we use this for our valuation later on. Below that, you can actually see, we actually sum up the total amount of financial services and lending revenue divided by the total number of products that are on SOFI's platform to actually understand the revenue generated per product. So you can see this number, right, started off in the $51, even $53 range, and then slowly declined over the years. Now, this actually dropped all the way down to the low 40s, 44, 43, and the last two quarters, about $40 revenue per product. However, with the introduction of the loan platform, that has actually increased to $46 per product again. So actually this, declining revenue per product is actually not a concerning issue for me, because I see this as, a side effect of the rapid member growth. Now, if you take a look at this graph, I think this graph will better explain what I mean. Let me drag this graph up over here so I can draw on it. Now, if you take a look at this graph over here, what you actually see is that, the total revenue for SOFI, right, in terms of their lending and financial services product, has been increasing over the years. You can actually see, right, the graph is quite a steady increase. But what is actually decreasing is, you can see this red line over here. This actually represents the revenue per product. And so what this means, if you put 2 and 2 together, is because, you're onboarding more and more people onto the product, and because people are perhaps newer to your platform, they will not, start by spending so much money, which is why you can actually see revenue per product decreases while overall revenue actually increases. So you can actually see that, the increase in revenue is actually driven by member growth. Now, if you think about it in another way, if you actually sell 1 cup of coffee for $5 and 10 people bought a cup of coffee from you, so at the end of the day, you made $50, right? And perhaps, on the very next day, you decided to run a promotion and charge $4 for a cup of coffee. Now, instead of attracting 10 people, now you attracted 20 customers and made a total of $80. So therefore, despite bringing in less revenue per cup of coffee, $4 instead of $5, your overall revenue still increased by 60%, which is basically what we are seeing happen over here for SOFI. So if you take a look at the most recent quarter, you can see, like I was mentioning previously, the revenue per product is inflecting upwards, and I believe, as they continue to ramp their loan platform business, as they continue to onboard more and more new clients, and these clients stay onto their platform, they're able to cross-sell them more products. This is something that we can see continue to increase in the years ahead. Right, so let's get down to the actual valuation. Now, I feel like this segment might be a little bit complicated because it's quite long. So, if in any part of this segment you have any questions or anything that I'm not particularly clear on, you will have questions to ask, please do feel free to leave them down in the comments below, and I'll get back to every single one of your questions, okay? So I do want to start by pointing out some of the differences between the old valuation model that I used previously and this updated valuation model. And hopefully you can see some of the nuances before I actually dive in and make some changes in this live Excel file. And I hope that at the end of this, you realize that, with some very minor tweaks in SOFI's business, they can actually generate a lot of revenue and profitability for themselves. Now, as an investor, I guess we do have to understand as well at the same time the limitations of the valuation models that we are using. And so before we go any further, I just want to point out a couple of things. Because I've been, sick for the past week, I haven't been able to work on this much. I will take this as just my first draft that is 80-90% done. Good enough to basically give us a high-level understanding of SOFI's valuation. But is it the most accurate? Perhaps not, right? This is something I will definitely be updating in the weeks to come. So one of the issues I have with this model that is basically quite hard for me right now to account for when SOFI actually removes inactive members. So although the new members added per quarter may be correct, which is the numbers that you see over here, okay, it's actually quite hard for me to account for when SOFI will remove their inactive accounts. Whether or not this is something that they're going to be doing quarterly or not remains to be seen. So the best thing I can do right now is just to manually adjust these numbers every single quarter. Now, another thing I just want to point out is that if you take a look at the total quarterly revenue over here, I'm basically working on a net revenue basis. I haven't adjusted this for corporate revenue. I think the corporate revenue segment fluctuates quite a bit. I can definitely just take an average over here. But because this isn't really a core part of the business right now, what I like to do my valuation on is basically just to analyze the core parts of the business. And in terms of this corporate revenue, this is something I'll be looking to understand the trend a little bit more, understand how their payments to some of these revolving credit facilities work, and then to see whether or not there's a better, more accurate way for me to model this in future. Okay, let me start by pulling up this screenshot over here. Let me put it side by side. Okay, I'm just basically going to be comparing 2025 with 2025 so that you basically understand where I'm coming from, right? And then we are just going to extrapolate the understanding into 2026. So let's dive in and look at some of the differences. If you remember earlier on in the video, I basically mentioned two of the metrics that could affect the valuation is basically member growth and the fee-based revenue that is basically from the loan platform business, right? So how is this affecting our valuation models? Now, let me pull up this screenshot over here. I'm just basically going to compare the 2025 numbers, and then you can extrapolate that same relationship to 2026. Now, in terms of the first difference is basically in terms of member growth. You can see over here, basically what I've done in the old valuation model, right, in this screenshot over here, is that I've calculated the member growth on a year-over-year basis. Now, what happens if you realize the members added each quarter becomes quite lumpy, and because of that, these numbers are actually quite unrealistic. So what I had to do, and in the end, is to actually take an average of these four numbers to see over the course of the year what was the average number of members added per quarter. So in the old valuation model, that actually gives me a number of around 764,000 members added per quarter. Now, the issue here is that in the third quarter of 2024, SOFI has already added 756,000 members. Now, if I were to keep the same assumption, that would mean that I'm assuming for the coming quarters, SOFI will not be able to accelerate their member growth, which is quite unlikely, seeing how macro conditions and everything are turning around and favoring them right now. Now, the second metric that actually affected their valuation is the fee-based revenue, and what that affects is actually this component over here called revenue per product. Now, this revenue per product, you can actually find it in the switch over here at the bottom. Okay, and so basically these two are related. So previously in the past, because when you take a look at the revenue per product trend, if I go back to the fundamentals page, right, you can actually see the revenue per product trend was around $44, $43, even $40 at one point. So because of that, in my old valuation model, the bear case for revenue per product came in at $42, base case was $44, and in the bull case was $47. However, because you added in this new loan platform business, right, what happened is that in the third quarter of 2024, the revenue per product already came in at $46.17 over here. So because of that, this $46.17 will now become my bear case, which means that they have done that in the third quarter of 2024. They will not increase that number in the fourth quarter of 2024, despite the improving macro conditions and as well going into 2025, right? In the base case, I assume that they managed to increase this revenue per product by $1 to $74, and in the bull case, this will eventually reach $48 over here. And so with that, you can actually see that in the old valuation model, using the base case, that would actually give us an EPS of around 27 cents. But if we change the way we account for members and the revenue per product, all else remaining constant more or less, that actually brings us to around 38 cents EPS. Just giving you a sneak peek, but there's a lot more to the valuation than that. Okay, this is for the benefit of those who have never seen me done this before. Basically, how I like to do my valuation is to use some switches over here. So if you can take a look at this at the top column over here. It says 2025 switch, and then it has the number 1 here. So this switch basically allows me to switch between 3 different scenarios. So you can see I can change the number from 1, which is representing a bear case, 2 represents a base case, and 3 represents our bull case. And so what happens is that, let's say I put this at number 2, which is our base case. What this does is that basically it pulls from this bottom table over here. So as you can see in this bottom table, all right, if my 2025 sentiment is base case, you'll take a look, it'll pull from this data over here, and it assumes that quarter over quarter member growth is at 5%. The products per member is 1.45. Revenue per product is $47. My tech platform is growing at 14% year over year, and my net income margin is 14%. So they take all these values and they plug it into the valuation model that you see over here. And so based on that, we can actually, adjust different scenarios for various years to see what we end up with. And so what I'm going to do is I'm going to show you one possible scenario, or at least the scenario that I'm using to model out my SOFI's valuation as the scenario that I think might be the most likely to happen in the next 2 years. So let's take a look at the scenario that I think is most likely to play out over the course of the next couple of years. Now, I just want to say that my fourth quarter 2024 numbers that you see over here, these are not my actual projections. What I've actually tried to do is actually to model this as closely as possible to SOFI SOFI's guidance, with one exception, because in SOFI's actual guidance, they actually guided for their net income margin to come in at around 5%. But I think having produced a 8.8% net income margin in the third quarter of this year, you can see my base case, I'm basically assuming a 9% net income margin, right? I'm going to draw this box over here for you to see where I'm getting this 9% from. So as you can see in my 2024 switch, the number is 2, which is basically pulling from my base case, 9% net income margin. Everything is there in this blue color box over here. So that's quite straightforward for 2024. So what I want to focus on is 2025 and 2026. Now, my 2025 switch, right, I'm actually going to put this to 1, and the sentiment here is actually a bearish sentiment. Why do I want to put this here? Is because I assume that there's going to be a recession in 2025, and it's going to affect SOFI in one way or another, right? So what this means, okay, if I take a look at the box over here, it means that in 2025, in my bear case, the quarter-over-quarter member growth will actually be 4.5%. Now, how do I actually get this number? It's because if you look over the last couple of quarters, right, quarter-over-quarter member growth has been, pretty steady, actually around 6 to 8%. But as the number of members in total, right, in totality basically gets bigger, the percentage of growth gets smaller over time. So that's where I actually get this number from: 4.5, 5, and 5.5. So in the bear case, quarter-over-quarter member growth in 2025 will be 4.5%. Products per member slightly lower at 1.44. Revenue per product, no change from what it is in the third quarter of 2024, so $46. Tech revenue growth will be only 12%, and net income margin of 12%, right? So later we will see, the kind of earnings per share this will generate. Then coming out of the recession into 2026, then you can see I have adjusted my switch here to 3 with a bullish sentiment. So because of that, I will be pulling from the bullish sentiment at the bottom over here. So if you take a look, I've actually color coded the years if you haven't realized by now. So 2026, which is the green color switch over here, quarter over quarter member growth, only 2.5%, like I said, because as the number of total members get bigger, right, the percentage-wise of quarter-over-quarter member growth, it gets harder to become, a big percentage, right? So it slows down from 4.5% quarter-over-quarter member growth in 2025 to 2.5% quarter-over-quarter member growth, right? In terms of products per member, perhaps that comes in at around 1.52 because they start to, expand the number of products each member uses. Revenue per product, $54. This is actually not too far-fetched if you consider that back in 2021, they were actually around that number. Let me bring you back to this fundamental page over here. And if you can see in the third quarter of 2021, right, they actually generated $53.44. So this is actually not too far-fetched in terms of a bull case that we can expect. Tech revenue, 18%, again, not going past that 20% mark. So we are being quite conservative here. And net income margin of 20%. Now, if this scenario actually plays out, I want to bring your attention to the bottom over here. This basically shows us the annual overview of SOFI's business. In 2025, you can actually see that their earnings per share will be about 31 cents, and in 2026, the earnings per share will be around 81 cents, which is slightly above their guidance of 65 to 80 cents. And so with that, let's apply a P ratio to the earnings per share. Now, if you take a look at the fintech industry on the whole, you'll realize that SOFI's P ratio is currently the highest, right? Because they just turned profitable. So if we ignore that and we just look at the other fintechs, Lending Club, Nubank, Square, and Robinhood, you realize that, the P ratio ranges from around 32.7, let's call it 33 times PE, to around 59, 60 times PE, right? And so on average, if you take the average of these 4 PE ratios, you'll end up getting an average of around 45.75. So basically what I've done here is to actually apply a couple of different PE ratios. I've taken a PE ratio of 30, which is below Lending Club, which means that the sentiment towards SOFI in 2 years' time will still be worse than the sentiment towards Lending Club. And then basically on the high end, the PE ratio, I basically use 55, which is somewhere in between Square and Robinhood. And so if we apply a average PE of around 45 times, you realize that in 2026, the price of SOFI should be around $36.98. Of course, if you take a higher PE ratio of 55, you will end up closer to the final level of Anthony Noto's PSU, right? $44.46, and his third level is actually $45. So he basically will hit it if that actually happens. Of course, if sentiment around SOFI is still bad for whatever reason, it's only trading at 30 times PE, then in 2026, this stock will actually be only around $24.25. But this is where the problem actually comes in, and I want to adjust this to show you how it actually affects the valuation, which is the third problem I have with this model. Now, it has to do with the number of shares outstanding over here. Now, basically, I believe, I think I've read an explanation on this previously. I just can't seem to find where the article is anymore. So I will be writing into investor relations to check, and I'll give you an update once they reply. But basically, I think there's some discrepancy between their net income number that they reported for the fourth quarter of this year and their earnings per share. So because of that, right, I had to increase the share outstanding to around 1.4 billion. To account for this discrepancy and assume a 2% dilution year over year from then forward. And then that is how I actually get this 81 cents EPS number. But the issue here, for me at least, is when I did that video on the convertible note, I believe that the overall dilutions from the convertible note stands at around 130 to 140 million shares. So I'm not sure where the additional dilution actually comes from. Perhaps it comes from paying off the 2026 note. I'm not too sure, or maybe I'm missing something. Because if I only add the 140 million shares to the current shares outstanding, that will put the total shares at 1.24 billion, assuming a 2% year-over-year dilution. That will give me an earnings per share of 91 cents. And then that is where you can really see the impact of SOFI's increased member growth and the increased revenue from the loan platform business. Now, even if I assume the dilution to be 4% and then 3%, that still makes their earnings per share at somewhere around 89 cents. So if you take this 89 cents earnings per share and you apply a 45.75 times PE, you'll still end up with a share price of around $40.55 by the time 2026 rolls around. So I think, like I mentioned previously, every single valuation model has its limitations, and as an investors, we have to understand the limitations. And so, as I was saying earlier, take this valuation model as my first draft. It gives you a high-level understanding of SOFI's valuation in 2026. Is it the most accurate? Perhaps not. I can definitely, add certain things to this valuation model to make it a little bit better, and I'll update it in the weeks ahead. But, I decided to show this, first draft because I don't want you to just see screenshots, but to actually show you the whole Excel file so that you can actually understand the thought process behind how I think about companies and how I actually put this together. And this will differ with actually different companies because not all companies can be valued using a traditional DCF, and it's important for us to actually understand their fundamental business. So I will definitely be posting an update on the final version of this valuation model, and at the same time, one of the companies that has been highly requested in the comment sections will be coming out next. So thanks for your time, and I'll see you in the next one.